Have you ever wondered about the potential benefits of investing in mutual funds? This is Wealth Wizards, and in today's video, we'll be focusing on mutual funds, where we'll expose 7 common mistakes that might be holding you back from maximizing your wealth. Whether you're new to investing or have years of experience, mutual funds have likely captured your attention with their promise of portfolio diversification, the potential for higher returns, and the guidance of expert fund managers. Before we start, don't forget to like and subscribe to our video. Now, let's dive in and uncover these pitfalls, which, if avoided, could significantly impact your financial journey. Let's quickly define mutual funds and examine their appeal before delving into those pitfalls. To invest in a diverse portfolio of stocks, bonds, or other securities, a mutual fund pulls money from numerous individuals. Through this pooling, even small investors can benefit from risk diversification and access to competent management. The appeal of mutual funds is that they have the potential to generate returns that are greater than those of conventional saving strategies. They also provide diversification, which lowers risk from preventing you from putting all your eggs in one basket. Expertise and market knowledge from seasoned fund managers can help investors make selections. Mistake 1. Chasing past performance. The tendency to chase investments that have shown outstanding historical success is a common mistake made by investors. Realizing that past success is no guarantee of future progress is essential. What brought in big bucks in the past isn't always a surefire bet for success in today's economy. If you want to fix this mistake, you need to start prioritizing consistency and long-term success instead of quick wins. Take a broader view of the market and avoid the temptation to chase hot stock picks. Investigate the investment plans under consideration to see if they fit in with your long-term objectives. Don't underestimate the value of the fund manager's expertise. Their observations might have a major impact on the fund's future success. Diversification, when used carefully, can help minimize the possibility of underperformance. If you invest in a wide range of funds, you can protect yourself from the ups and downs of the market. Using this method, your portfolio will be less affected by the poor performance of any one fund. Maintaining a diverse, well-informed investment strategy is essential to achieving your financial goals over the long term. Mistake 2. Excessive diversification. While diversification is essential for protecting against loss, excessive diversification might reduce your earnings. Having too many different investments can make it harder to keep track of everything and reduce your chances of making significant gains. Aim for a balanced and clear approach to avoid the diversification trap. Rather than dividing your money too thinly among a wide variety of investments, focus on a small number that together effectively reflects your financial goals and risk tolerance. Diversification can be achieved without entering a world of complication if careful planning and selection of investment instruments from different assets classes are used. When it comes to developing a strong investment portfolio, remember that quality, not number, is what matters. Finding the sweet spot between too much and too little diversification allows you to craft a manageable portfolio. With careful planning, you can make smart investment choices to keep your financial future in your hands. Mistake 3. Ignoring expense ratios. Expense ratios, no matter how small they may seem, can have a major impact on your investment returns over time. Annual management fees charged by a mutual fund to its shareholders are represented by these ratios. When choosing a mutual fund, you should give serious consideration to the expense ratio. Check the fund's costs against those of similar funds and decide if they are reasonable given the fund's past performance. Choose funds with lower expense ratios if you're hoping to maximize your long-term net returns. Keep in mind that the savings from fewer fees can add up over time. In the next part, we'll look at the other possible mistakes that are slowing you down on the road to financial success. If you're enjoying this video and finding the material to be helpful, please consider giving it a thumbs up and subscribing to our channel. Make sure you're subscribed to our channel so you don't miss any of our future updates by clicking the bell icon. Let's keep exploring the interesting world of mutual funds. Mistake 4. Rash market volatility reaction. The presence of risk is unavoidable in the world of investment. Realize that acting impulsively in response to short-term market swings can put your entire investment strategy at risk. Market volatility is appealing because of the chances it presents, but acting hurriedly, especially in response to market downturns, can prevent you from taking advantage of the probable long-term rewards that often follow. Volatility in the markets is comparable to a passing storm. It can cause disruption in the short term, but it doesn't necessarily set the tone for the future. Making judgments under the influence of your emotions can cause you to lose out on profitable chances. It's crucial to keep your cool in the face of fluctuating market conditions and not let short-term fluctuations affect your decisions. Focus on the broad picture and make sure your investments are in line with your overall plan. Consider taking a measured approach in the face of market swings. When things seem chaotic, taking stock of your investment portfolio and approach can help bring everyone into focus. Keeping an eye on your investments on a regular basis will help keep them in line with your goals. Never forget that a financial advisor's advice is worth considering, even in volatile markets. You may use their knowledge to make better financial decisions that will endure the test of time and add to your wealth. Mistake 5. Failing to review and rebalance. After first diving into mutual funds, many investors make the fatal mistake of not giving their portfolios the attention they deserve. Your own financial goals and the investment landscape itself may change over time. Mutual fund portfolios that aren't reviewed and updated on a regular basis can drift apart from their owners' evolving financial objectives. To stay the course, it's important to review your holdings on a regular basis. Given the ever-changing sands of your own financial situation and the larger market dynamics, it is essential to establish a disciplined timetable for evaluating your investments. Rebalancing is a sophisticated technique that adds depth to the art of portfolio management. Adjusting your portfolio's asset allocation to keep it in line with your risk tolerance and financial goals is a crucial investing strategy. Higher returns can be unlocked over time by active participation in portfolio management and the use of sensible decision-making. Taking the initiative is crucial in the world of investing. To successfully ride waves of the market, you must fine-tune your investments in the same way as a skillful sailor constantly changes the sails. The market's tides may rise and fall, but your commitment to adjusting your holdings to reflect your shifting financial goals will guide you. Never lose sight of the fact that building money is an ever-evolving process that requires your constant attention and intelligent management. Mistake 6. Relying on public opinion. The influence of the masses is both appealing and dangerous in the financial markets. Leaving your judgment up to the masses is a surefire way to get lost in the shuffle. Even if a mutual fund is getting a lot of attention, that doesn't mean it will be a good fit for your specific investment approach just because of the attention it's getting. Keep in mind that the things that are now trending might not be the best fit for your long-term financial goals. The appeal of trends can enchant, but it's simple to give in to the general public's opinion. However, this route may cause you to lose sight of your own personal financial compass. Your investing decisions should be based on a thorough study and a thorough grasp of your financial situation and goals. And don't be shy about consulting experts when the time is right. With an advisor's help, you can maintain your course regardless of fluctuations in the market or other external factors. Like a well-tailored suit, your investment strategy should be custom-tailored to your specific needs, so it's crucial to assess mutual funds according to how well they've historically performed, how much risk they provide, and how well they line up with your financial objectives. Your research and financial roadmap, which should inform your investing selections, should be unique to you and not a carbon copy of anyone else's. After all, you need a strategy as distinct as your fingerprint for your financial future. Mistake 7. Having impossibly high expectations. Mutual funds may offer large returns than other investment options, but smart investors still know to keep their expectations realistic. All investments, including mutual funds, are subject to market fluctuations. Setting your sights too high on consistent profits might lead to disappointment and poor decision making. Gain as much knowledge as possible on the performance histories of mutual funds before making a financial choice. Before investing, determine how much of your savings you can afford to lose. With sensible expectations and an awareness of the market's inherent volatility in mind, better investment decisions can be made. The potential benefits and drawbacks of every investment must always be evaluated against each other. As we conclude our exploration of these 7 mutual fund mistakes, we hope you've gained valuable insights into optimizing your investment strategy. Remember, each decision you make should align with your long-term financial goals and risk tolerance. Now, here's a question for you. Which of these mistakes resonated with you the most? And how do you plan to avoid it in your investment journey? Share your thoughts in the comments below. Thank you for joining us in this discussion. If you found this video helpful, don't hesitate to give it a thumbs up and consider subscribing to our channel for more informative content. Your support means a lot to us as we continue to provide you with insights to enhance your financial well-being. Until next time, happy investing!